Okay, cool. All right, I think we're live. Says we're live. We'll act as if we're live.
Okay.
All right, morning everybody. You guys have probably seen us before. We intend to do these sessions kind of every Friday to give you guys a rundown of what this is all about. So if you're new to this space, the purpose of this call is not to go deep into the weeds on what I said on Twitter last night or why I said it or why we're going to go up or down today, but to give you guys a high-level overview of what Matt and I look at here in vol signals with VS3D and how it differs from a lot of what you might be used to in this space. Matt, you want to kind of give a brief overview of what we're doing here with the position modeling?
Yeah.
Just the why behind it?
Yeah. I mean, the why, really the why behind it is because, both of us were on the market. Well, he was on the market making side for 15 years. I worked at banks for about 30 years. And, it became increasingly clear to both of us that, the market didn't move. The market didn't move in random directions. There was some real hedging influences driven by flow. So flow dictated a lot of what Vols had to do as a market maker, and what I had to do on the bank side to some extent as well. So we just became increasingly interested in flows, and then as the zero DTE the options have proliferated, it's become very clear that understanding the zero DTE landscape, understanding not just where the open interest is, but who holds the open interest, is very important in terms of how the market may behave in a given day. So that was really the genesis of it. And that's,
of course.
But we're both just really, both fascinated by flows and their effect on the market. And there's absolutely no doubt that, we're not here to tell you that if you understand flows, you're going to get everything right. But we like to say, if you understand the flows, you can tilt the odds in your favor, which is all you're trying to do as a trader.
Exactly. I think that's a good way to put it. One important thing for this too, I think people mean different things when they say flows. So obviously the way I look at this is, and I think Matt, you probably agree, flows create positions, right? So when a customer trades an option, they're probably doing it for a reason that is not to dynamically hedge it. And so when they trade options, there's a lot of this stuff that winds up netting against each other. If I buy a call that you're going to sell as a customer, we're going to just balance out. There is no position. But the reality is most of the trading actually does wind up creating positions. And so the positions have to be held and managed by somebody. And that somebody is usually the market maker. And so I worked at a firm called Belvedere Trading. I was a partner for my entire adult life. I was a lead trader in the SPX and worked on everything from, trader UX type projects to algorithmic hedging. But we held positions and hedged them fairly frequently. Matt probably traded bigger positions than I was used to. Sometimes I recall being stuffed by some of the stuff they would send down the pipes from the banks. But similar business model. But again, the idea really being that it's the net imbalance or the imbalance after you've netted out all the trades that's held by somebody like us that actually winds up causing a future influence on the market. A lot of people get anchored to the idea of what traded. You might have seen places like Cheddar Flow or Unusual Whales kind of make their brand by posting something from time and sales and then giving you infinite insinuation. There's no information there. It's obviously clickbait. The reality is, at best, when you see those things, if there's a market impact from that trade, assuming they got it right in the first place, it's done, right? And so once it's done, what we care about next is a different kind of flow. It's a hedging flow. And Matt, we're modeling vanilla options.
Yes.
When you're a market maker, you have a pretty obvious business model. You don't want any big position. If you do want a position, it's probably not the one that you have. And oftentimes what you have left is a need to hedge the resulting position that you do have. And it's that fundamental business model that creates the generalized approach that we have here. A lot of people like to think that market makers do something, they game things, they're going to antagonize customer flow. It's not really how it works. there's so much volume and so much flow. You can't have this strange quantum state where you're simultaneously attacking all of it. The reality is you just absorb it all and you wear it and you hedge it. And so, Matt, you want to explain a little bit how the hedging works?
Yeah, with the hedging from I mean, basically,
Yeah, just in general, what do we care about?
Nope. I think you cut out a little bit. Hello? Uh-oh. Technical difficulties. Oh, okay. We're still live? Okay. Looks like Vol's froze. Um, so, okay. I'm still live. I'm the only one. Okay. So basically, when the market maker takes on a position, if it's a call, if the market maker gets long a call, gets sold a call, he's then going to hedge by selling futures. If a market maker gets hit in a put, he's going to buy futures, excuse me. So that is the market maker is always looking to basically get delta neutral. So if you take on an option, you're going to do the offsetting trade in futures. That is the way that the market makers hedge with ES minis. Oh, we're stuck here. I'm still alive. It looks like. Oh, he's coming back. He's coming back. I was just explaining. The hedging flow. So basically, to be clear, as market makers get hit in options, they are hedging using minis. Again, if they get hit in a call, they're going to be selling minis. If they're selling a call, they're buying minis, and puts is vice versa. So that's really the first order of hedging, and then the next order of hedging would be to try to find a similar option to sell out if you had just bought, or to buy if you had just sold. That's really just.
Oh, you're talking about covering too, huh? You're going.
Yeah. Oh, yeah. Hedging and covering, the whole thing. Both.
Yeah, there's like a waterfall of risk. So obviously, once we absorb this position, we have to hedge the delta. Like Matt just said, it's the trade delta. By the time you see that position reported on the tape, it's already done. There's nothing for you there. But the next thing, the gamma, the charm, Vanna, all that stuff is modelable. For us, though, the problem is even more sophisticated. Once we hedge the delta, that's the easiest thing to do. The underlying is liquid in this case. And once that part is taken care of, there's a waterfall of risk. It's not just options or Vega. It's where are you holding your options or Vega? Where are you concentrated? You want to eliminate Vega exposure, balance gamma exposure, balance gamma theta. Then you want to make sure that you're not overly exposed to any parts of the term structure. Specifically, beyond that, it's skew, kurtosis, et cetera. It's a game that's always in play. And in the end, when there's an imbalance, a concentrated risk somewhere in your position too, that's going to show up in pricing as well. Beyond the scope of this call, probably, but you guys get the idea. I posted overnight or this morning, can't remember what time it was, about skew, the pass-through is skew. One of the things we get in our representation of the position is an ability to kind of estimate or simulate what gamma would be at different levels in spot and across time. And if you pair that with, that dislocation, for example, of what is the profile right now versus what does the profile look like if we're down X%, those things correlate very tightly with our position for a good reason, because we price against ourselves. We do this because it balances our risk naturally. If we're short something and it's marked high, it has better Greeks for us to begin with. And if we're short something that's marked high, we also know that the next price to sell more, to absorb a bigger position and carry it, we charge an adequate price. And so all this stuff is very reflexive, very, very reflexive. Matt, when did you start? Like in general?
My goodness. I started in 1997.
That was a good year.
97.
Trading basketball cards at the time.
Yeah.
It's good. So when you started, none of this data was even available. Is that fair to say?
No, yeah, everything was very rudimentary. It was very old school. We were still calling almost all the option trades are made electronically. Like anytime, yeah, my option trades are. Option trades are
On the
almost all
floor.
made over the phone. Yeah.
Yeah.
And futures, even trading futures to hedge, you had to call down to the floor to trade futures. It was a different
Oh, really?
world.
Like big
Yeah.
spoos at the Merc?
Yeah, it was a different
That's
world.
kind of wild.
Yeah.
Yeah, that's wild. And fewer expirations, obviously, at the time. I don't believe the data set that we use now is really available until after 2008. And so this concept of gamma estimation or trying to build the dealer profile in order to get any kind of inference about future flows from it probably wasn't really commonplace until I want to say 2018 or 2020. Have to give a shout out to Squeeze Metrics, I think, for really popularizing the whole space. And then, of course, Spot Gamma came out with their naive gamma model and plugged that in and kind of productized the information that Squeeze Metrics kind of solved about the market. That concept, though, was rooted in an assumption that may have been actually pretty valid when Matt started, where a lot of the order flow is just traditional hedging of equity portfolios. We're kind of down the weeds in financialization and all the creative ways to use options and vol at that point. I don't think it's mostly if you own stocks, you buy a put, and if you own stocks, you're going to sell a call against it to kind of finance that protection. And so what we got out of that was a long period of time with which kind of the world was waking up to the idea that our business matters, but also looking in the wrong direction or basing their assumptions on a faulty assumption. An assumption that doesn't really stand up to reality meaningfully. And obviously, you guys can understand if you start out with garbage in, you will get garbage out to some degree. 2018 was a great example when this was kind of coming up. Ironically, it was a time when a lot of the customer hedging or defensiveness around their own positions created a waterfall-like behavior in the market that reflected or looked like negative gamma to the downside. But the reality was we were flush with positive gamma, and that was probably, you could pick that up in the metrics, pricing metrics at the time. The irony was that had nothing to do, that waterfall had nothing to do with our negative gamma. It was more like customers treating their own positions like negative gamma. As zero-day options came on board, it became completely obvious that this assumption was completely erroneous, right? Even just think about David Chow's Iron Condor. Imagine two situations. I guess in VS3D, we probably should do this. We should probably just model the naive assumption to show you guys the difference. Because, for example, Christmas Eve, when David Chow put on this giant Iron Condor, the gamma influence was super local. And sometimes it was massive, sometimes it was nothing. But the reality was, if you modeled this via the naive assumption, it would have given you massive differential, like a huge amount of positive gamma to the upside and an equally huge and threatening amount of negative gamma to the downside. But the reality was they were 5-point spreads. A naive assumption would have picked up 2 calls to the upside and 2 puts to the downside and said, market makers are short the puts and long the calls. Not good enough. The next thing that became kind of popular to try to address this, I use big air quotes, was aggressor tagging. And this is where I think there's this funny thing I've seen people come back at me with. Options price reporting authority delivers a data set that indicates whether something is bought or sold by a customer. But they use inference. They use what's called DDOI. It says if it's trading by the bid, that means the customer must have sold it because they're selling at a low price. That's not really how it works in real life. Always, it's not that simple. We have to keep very tight markets. So oftentimes we have a very tight bid ask, but our values are moving around according to what we think is happening in the market at that time. It's not so simple as saying if it's 1 at 2 and it trades 110, it was a sell. So both of these things, just not accurate, not sufficient. If you actually want to use this information and make trades off of this and risk your own money, you need to do better than these assumptions. So Matt, why don't you tell us what we do? Well, not exactly what we do, but high level.
High level, what we do in VS3D is we are looking at, we build the position from the actual SIBO data. So the actual positioning data on 10-minute intervals. So we build the entire position with a data set that's been verified by the SIBO. We're not just guessing if things are bought or sold and who's buying or selling them. We know who is buying and selling each position. So we break that down and that we break that down into different participants, and we make some assumptions about the hedging behavior of market participants. And from that, we are able to, often give pretty good signals on where the market might speed up, slow down, where the market might head to, and so forth. So we do that. That is what we do. I mean, it's pretty powerful. Again, there's no panacea. Anyone who sells you, something that's like 100% gonna tell you where the market's going that's just a lie. So this information is extremely powerful, but it's a great data point to help tilt odds in your favor as a trader.
Exactly. So we'll show you guys the dashboard in just a second to talk more about that. But that's a key point. What Matt said also is that, we'll talk more about the entity type and hedgers and all that kind of stuff. But the most important thing to understand is this is not deterministic. It's still probabilistic in a very real sense, right? And so I get asked this all the time, up or down, and where are we going? It's really exciting when you get a pin right. Sometimes I punish myself and try to get really, really precise trading outcomes because it's fun. But you don't need to play it that way. The reality is you're never going to ever be in a situation where any model will tell you exactly where we're going to land or exactly what the range is going to be, because you or I could just step in and trade hundreds of futures and change the entire outcome of the supply and demand equation. So anyone who tells you otherwise is lying to you. The mature way to understand this is to respect the fact that markets are supply and demand. Market makers have access to markets and technology that we don't have as customers, right? But we also have some advantages on our side too, because we are less rigid. A market maker that is managing all this zero-day flow has to have a system that's pretty predictable. They're playing a different game than we are. They don't care about the outcomes of individual trades. They care about the generalized business process and the outcome of their hedging model. And so with all that in mind, there is determinism, but it's more about determining the reality of the probability distribution, right? So if you understand the pricing or the price process as a function of supply and demand, we can say with, I say certainty. What I mean by certainty is that we know for certain that these positions exist. The only assumption that we're really relying on here is that we're not being lied to by the clearing corporation or the exchange. Hopefully that one's safe. We know these positions exist. We also know that generally speaking, for the business model to work, these positions have to be hedged a certain way. It doesn't mean we know exactly what time, at what level, which firm will buy or sell what quantity of minis and why, but that doesn't matter because even that level of resolution would confuse you and spin you around in circles anyways. The general thing that's going on here is going to give you two things. Sometimes it gives you an estimate or an implication for drift, like a trend up or down. Today, if you can see in VS3D, we have kind of a boundary here. We'll talk about this in the morning meeting in about 12 minutes. You guys are invited to the Discord to just follow along, and there should be an event in the free chat there that we're going to open up the morning meeting to show you guys how we do this every morning. But this boundary here kind of tells you something about the potential trend towards the end of the day. The reason is this position that we have on the left, the zero-day position, is going to eventually decay. It has to meet its maker at 4 p.m. The shot clock runs out, and whatever hedge is held by us against this position would no longer be a hedge. It would just be naked exposure. And so we kind of passively have to keep this connected to the actual mark-to-market values of the options, which you guys can easily observe yourself, right? These bid asks are tight. So the deltas that we're modeling are, they're verifiable in some sense. And it's the keeping the position delta neutral. It's that business need that creates this process where in this range, for example, the market maker position, again, the slice of the open interest that's actually held by people that will hedge it, creates a need to sell futures. It's not a lot. Our model right here gives you an example. In the tooltip, it tells you hedge product to trade. That's like in 5 minutes time from this point on, how many futures in total will be required to sell against this position. You can see it grows sometimes, and it should grow because as these positions expire, these forces become bigger and bigger. You can just imagine yourself, if you own an option, if you ever had this experience yourself, watching an option near your strike price at expiration. Its price will move around according to whatever delta it might be, but as it goes out of the money, and the clock starts to tick, its delta goes to zero fast. You're not getting your premium back because of a small move anymore. Whereas if it's in the money, it behaves exactly like the underlier. And so at the end of the day, the options delta is going to either go to zero or 100, either positive or negative, depending on whether it's a call or a put. But it's going to be just like what we call delta one. Very important. The flip side, we have gamma up here. And so, Matt, I don't know if you talked about gamma before, but how would you explain this very basically, like how to understand what it tells you about the market's potential behavior?
Yeah, the gamma tells you more about how the speed of a move, whether in periods, in areas where there's heavy gamma, the market is going to move slower, because gamma basically is just your change in delta with regard to spot. So if the delta of if there's a lot of gamma, meaning that your delta is changing, the delta, there's going to be a lot of hedge product to trade. Okay, so in heavier gamma areas, you can expect the market to move slower, because there's just a lot of minis to get through. As we go up, market makers need to sell a lot of minis. As we go down, market makers need to buy a lot of minis. And so it tells you more about like the speed of move, the potential speed of moves. So it can help you set up some nice trades if you have odds that the market's going to move slowly through an area.
Exactly. And it's not so much that like market makers wind up doing any kind of aggressive selling. Oftentimes I see people say that, market makers cause a reversal because suddenly there's positive gamma. It's not really how it works, obviously, because this is about providing liquidity or not providing liquidity. If it's negative gamma, like properly negative gamma, it's problematic for us. It actually is really difficult to manage. It's also very rare. You probably hear about negative gamma all the time, but the percentage of time that we're actually entrenched in a negative gamma range is very, very small. The reality is oftentimes what you're picking up on is just a differential. We might be long 10 billion notional gamma as a industry, a complex overall, most of the time. So if the market suddenly is only long, like today, for example, right here at 68.35, where we're kind of implied to open after a really, really ridiculous round trip overnight, it's roughly half that. You can see the dollar per percent is that traditional notional gamma level that bank reports often cite. It's less than 4 billion today. And in the 67 handle, it was even substantially lower. And so the tradable influence then is not coming from this idea that market makers are long gamma, they're selling a lot of futures. No, it's imagine it like book depth. Again, to cite Squeeze Metrics, I'm happy to uplift the work of other good work. He has a report called The Implied Order Book. It's a great read as a primer. The way to think about this is like there is a shadow order book, because we are not going to market just arbitrarily selling futures. It's more like we have futures or delta to sell if the market goes to a certain level. Very much like if you imagine a futures ladder, if you've ever been on TT or whatever your broker platform looks like, it's almost like there's a ghost volume on the bid ask that helps to provide liquidity in a range and keeps the market contained. And so when the market moves higher, it's not so much that suddenly market makers are actively selling a lot of futures. It's not active. It's more like suddenly market makers are actually absorbing a lot more buying of futures. And so where without our presence, the market might move $30 on 2,000 or 3,000 minis. With us there, with 5 times the amount of gamma, all of a sudden 2,000 or 3,000 minis might move us $6. And so suddenly the whole character of the market's changed. And so if you're a futures trader with an upside target, and we run into what we tend to call a call wall, or at least it's popularized as a call wall. For us, it's just suddenly there's more gamma. We ran into a call position. You would want to know that, because that should change your expectation for how far the market can run. Same thing for areas where gamma is very low. I mentioned last night on my feed that the entire range in the 6700s is very, very thin in terms of market maker long option positioning. And this came from this position primarily here. Last night when I summed up the position, in the 6600s, there was over 15,000, I think it was maybe 15,900 and change net contracts long by market makers. Throughout the 6700s, the entirety of the position netted out to a whopping short 190 contracts. And then again, once you got into the 6800s, market makers net were long 5,000 and change. And so it's these positions that wind up creating a void in the middle, where in the 6700s, price can move around all over the place. There's no clear structure. There's no clear anchoring bias. There's nothing that's really compelling liquidity provision. And the opposite then happens once you meet gamma again. And so this happens every day. Not every position is the same, but the beauty is when you understand that these just define the way the market behaves. And so if you know, for example, that the market's going to run into a lot of downside gamma, or to sell off into the 6600s, you would not be buying puts that are high vol, expecting or needing rather a break of another $150. That wouldn't be a good trade. Probably in many situations like this kind of tells you there's so much liquidity there. There's so much support below the market that there might be good trades involving selling puts where you might not usually wish to do that there. And the rest of the market might be panicking, zero hedge with all the clickbait, markets in turmoil on CNBC, but you know that there's gamma there to support the market. Very different. Whereas same thing in here. Once you cross through some of these levels where we bounced overnight, for example, and started going back higher, this kind of tells you don't expect this to stop unless there's a serious heavy turn, because all of this stuff eventually creates passive delta to buy as well. A very thin gamma environment with delta to buy, the market doesn't need to stop. It just keeps going. So let's see. We are getting close to the morning meeting. We'll do these routinely, I think. They're a good way to start the Friday. Long week this week. We opened the week kind of the same way in which we closed it too.
A lot of stuff this week.
Yeah. Actually, I think, wait, is this fair to say we're actually trading against, like we're bumping up against the level at which we bounced on Sunday's overnight? Is that about right?
So yeah, that's about right.
It's kind of funny. We'll see what happens with that, obviously. But if you're watching on a live stream, I encourage you guys just follow along in the Discord today. I've instructed the admins to open up the morning meeting to make it public. For the normal guys, obviously it'll be on Zoom, so you can ask questions, etc. But it should be right there in the free stage for you. And we'll just go through our day the way we always do. We drill this stuff every day. As market makers, we used to have like morning meetings, literally. I hated them. I'll be completely honest. I hated them because no one was creative, never wanted to talk about anything. No strategy, no whatever. But it's actually kind of fun when you know what's going on and can explore this lens. When you get familiar with the data, the most important thing is repetition and obviously being correct in the way you're understanding it. And so we drill this every day. Every day at 9 a.m., we spend about 15 to 20 minutes on the dealer profile on the SPX vol surface, and then talk about single names as well. But the point is, it's this repetition and the community that really anchors it. So again, today's a freebie, but go ahead and join VS Pro if you are needing that or looking for that. That's the whole point. Otherwise, the data itself, this dashboard is VS3D. This is the access to all the Greeks. And this is not only designed by market makers, but it's actually built by market makers as well, software engineers from market making firms. So we should be well equipped to handle the fire hose of data, which will soon come our way when the CBOE makes available to us a much more rapid data set. So I'm going to switch over now to the Zoom, and we'll see you guys in the meeting.